Hello and welcome to this week's instalment of Nucleus Investment Insights. Our attention this week turns away from the more conventional asset classes as we take a look at opportunities in the alternative sector. Alternative assets can take on many forms. Art, wine, jewellery and classic cars often spring to mind, but in more reliable markets, opportunities can also be found in private equity, agriculture and small-scale infrastructure. Whilst typically the domain of institutional investors, the current high prices of traditional assets has renewed an interest in alternatives, which often bring lower correlation and diversification benefits to portfolios in these times. With these benefits comes a degree of risk, however, due to the broad range of alternative options out there that can often suffer from sporadic market pricing, poor liquidity and lower levels of regulation. It is an area where professional guidance is highly recommended. Because of this, joining us today live in the studio for a lovely change, we are very lucky to have Adrian Redlich. Adrian is founder and CEO of Melbourne-based investment house Merricks Capital and has previously held senior roles at Citadel Investment Group and Merrill Lynch. Merricks Capital specialises in alternative hard asset offerings with extensive investment capability and global experience spanning multiple asset classes. Adrian Redlich, welcome to Nucleus Investment Insights.
Yeah, thanks for having me and good to be present in the office.
Yes. It is indeed. Also here to share his thoughts on where opportunities may lie in the alternative space, I'm joined by Nucleus Wealth's Head of Investments, Damien Klassen. Hello to you, Damien.
Hi, Tim.
Good to have you in as well. And just a quick reminder before we get started, if you haven't already, subscribe and click on the notification bell to be notified of when we go live or have a new webinar to watch, or follow us on your preferred podcast platform. We also ask if you could take a moment to click like on the video now to help our show grow. And of course, for those listening in live now, feel free to drop in your questions in the YouTube live stream chat to have them answered along the way. So let's jump into our agenda for today. It's a broad agenda and I'm sure we'll cover off on many other areas, but just to sort of keep us a little bit on track, we thought we'd kick off with a bit of an overview and Adrian's thoughts on the crisis, vaccines, recoveries and asset classes to watch. We'll then jump into real estate, so we're looking at residential development, offices and perhaps a bit of a look at agriculture as well. We'll move across to debt markets. We'll round off with inflation as well, and an outlook of inflation, and then of course finish off, as we always do, on our investment outlooks and how we incorporate these themes every day here at the portfolios at Nucleus Wealth. So we might just jump into an overview, gentlemen. Damien.
Yeah, so I guess the main reason for getting Adrian on was we wanted to speak to somebody who's sort of on the ground sort of investing and looking at some of the asset classes that we don't see. So we see all the public markets and looking a lot at that, and we wanted to sort of really get a feel for some of these private markets, and especially we sort of feel as if last year in particular there was a lot of pullback on terms of banks not wanting to lend and people having to step into the breach, and now there's suggestions banks are starting to come back, and so that's sort of the reason we wanted to get Adrian on, and then really trying to dig into areas of expertise and stuff that he can show us. So I guess what I wanted to try and do was just to set a bit of background about how you're looking at the market and how you're seeing sort of vaccines, whether you're seeing like a sharp bounce back, whether you think it's going to be long and slow, just so I guess to put in context for readers or listeners, why you're investing the way you're investing at the moment.
Yeah, sure. Thanks, Damien. Look, our perspective is one around hard assets, so commercial real estate, agriculture, infrastructure, mining, and so that's our focus, that's our specialty. We'll look at investing in equity, debt, anything related to it. So we have a broad ranging perspective on it, but very much as I talk to it, we're going to be talking from the hard asset perspective as opposed to what's going on in the banking system related to things like Afterpay or GameStop or anything of that nature. So just it's worth pointing out that's our lens. Everyone's got their bias and their perspective.
And so you've obviously got a much longer time frame though than you can jump into GameStop and back out again before this podcast finishes. Finish that sentence probably. Whereas you're buying assets that there's big transaction fees. You want to be in there for 5-10 years at least, I'm thinking. Is that
Yeah, and we'll talk about it. You know, the predominance of where we've moved to over the last 4 or 5 years is actually to lend to people who are actually buying and owning and holding those assets. Over the journey over the last 14 years as Merricks, we have in fact been owners of these type of things, whether they be agriculture, whether it be commercial real estate, whether it be buying listed entities related to that industry. We've moved to that space because there's sort of been a vacuum or a pullback really since 2015-16 of the Australian banking system. And so COVID's added a new lens to that, in the sense it's hastened some of that retreat in places. Ironically, in others, it's actually opened the banking system up, and they've been much more liberal with what they're doing, and that's partly because some of the outcomes from the Banking Royal Commission and others have actually been unwound during COVID and actually liberated. So it's actually loosened things, and that's what happens. You know, that's my experience. You know, in the US, I was there for 10 years during the 2000s, and the banking crisis really of 2008, in my mind, was actually a consequence of liberating the commercial paper market and other things post 9/11. You know, so there's always a consequence. Politicians, governments, others push stimulus in a certain direction, and you know, often there's a consequence, you know, half a decade later.
Well, I was going to say, luckily for most of the politicians, it's an election cycle or two beyond when they've the people who actually made the decisions. So it's always like a
look, and I think most of them are probably trying to do the right thing at the time, but it's sort of that they're trying to solve today's problems. And they do suffer from short-termism, obviously, by the very nature of it, and it's only getting worse.
Yeah. Okay. So as you're looking at assets at the moment, are you looking at it with a view that this is going to be endemic? We're going to have rolling shutdowns and everything for years and years and years, or are you looking at it as, look, vaccines will come, we'll start opening up, and at some stage it'll snap back, whether that's 6 months away or 18 months away or whatever the time frame is, but at some stage we'll be back to normal.
Yeah. So the lens, we're predominantly focused on lending where the banks won't lend. If I'd say that's the predominance, that's 85% of what we're doing at this point in time. And we tend to go as an investment house where we think there's a scarcity of capital. So I think to get good returns, you can have a choice of trying to be the smartest person in the room, and we've worked out that's not us necessarily, and it's not most people. Or you can go to a place where there's a combination of two things. One, you have an understanding, and two, there's a lack of capital being provided. It's supply demand. If there's a lack of capital being provided, you tend to earn a little bit better. And so we think that's ironically in the lowest risk part of the capital stack that's dead at the moment. But so with that lens, the area we have been very active is in office, hotel, development in the last year, which a lot of people sort of said to us, why would you go there? Surely they're COVID candidates, if you like.
Absolutely. That was actually one of the first questions, because we're actually filming this recording this in a WeWork office where we are, and we just walked, and Adrian's company just bought some in Auckland.
We funded. So we're funded. We provided the debt for the WeWork development in CBD in Auckland.
And we just walked in past a bunch of empty offices. So let's go to people working from, because I think there's, for me, I can certainly see an argument for WeWork in terms of it being people downsizing from bigger offices, moving into sort of WeWorks and going, okay, it's much more flexible. I can have a 10 people and have a 6-person office, and then if I want to bring everyone in, because you have people working from home, and if I want to bring people in, I can scale up and scale back, and it's a short term. If shutdowns happen again, I can close the office down. So
sure,
I can see where people would want to. It's just in Melbourne, I think that hasn't been our experience, but I'm interested in how you're looking at the commercial property sector in general. Yeah.
So let's examine how that type of opportunity comes about as a starting point. You would think in a traditional landscape, you're talking about CBD offices, you would think that's the domain of the major banks. And the banks in New Zealand are the same as Australia. Yes. Effectively, they're one and the same. Slightly different regulator in terms of, so there's some nuances, but effectively, whether we're talking about New Zealand, Australia, they're fairly similar, and we treat them pretty much the same in terms of how we approach it. You would think, lending against office with a 15-year lease, which is what WeWorks have on the particular building, the banks would be lining up. Pretty good credit, really. Now, WeWorks owned in large part by Japan's second biggest company, you'd think it would make sense. Now, the reality is, banks are pulling back for a range of reasons, and partly driven by regulators. So there's a lot of press and sort of politics played around what banks do, but in large part it's driven by what the regulators allow them to do and where they're allowed to play. And the biggest step change in the last 5 years, and COVID, as I said, brought a new shift to that, is that the regulator, rightly so in Australia, in APRA, in New Zealand, it's the Reserve Bank of New Zealand, is simply saying to banks, right, you have a highly leveraged balance sheet. So look at CBA, for every dollar of equity, they borrow $13 in lots of different forms, and then they on-lend that. So if you're borrowing everyone's money, we need you to be prudent. We need to make sure the assets you're lending against are highly cash flow generative, so you can pay your own interest, you can meet all those needs. Makes sense, but it hasn't always been that way. We've gone through ebbs and flows of the regulator being much more liberal. But since the early 90s, where we really had the last major banking crisis in Australia and New Zealand, the regulator's done a pretty good job, and we've sort of averted a lot of crisis, partly lucky, but you'd say the track record's there that Australia's done pretty well. And so the regulator's saying, we're not so sure about these assets as a cash flowing type business. There's no judgment that they're really passing on the underlying value. Us as hard asset specialists, similar to you guys, how you think of asset allocation across everything, we're really focused as much on long-term value. And so if we're providing $60 million of debt against a $100 million asset, it's worth $100 million. To us, we're not particularly fussed whether it's worth 85 million or 115 million in 2 years' time. We're obviously focused on
being worth 60.
Worth 60. Yeah. So it's not rocket science.
Yeah.
Right.
And though, so you're taking, I'm assuming you're the first in line on these. What?
Absolutely.
Yeah.
Everything we do at the moment in debt is senior secured first ranking. And the reason we do that is, one, because we think we're getting outsized returns for doing that now, because there's a bifurcation. If the banking system will provide that capital to you, it's incredibly cheap. Cheaper than ever, as we all know, whether it's your own home mortgage, whether it's a business loan, a commercial real estate loan, farm loan. If you can get the money, it's incredibly cheap. If you can't get the money, there's a vacuum. There's very few providers. And so I think what we'll see in this space, the credit space or the lending space, we're going to see the emergence in Australia and New Zealand of a very big, deep, non-banking credit lending market. And I think it's going to be the alternative to equities. And there's a whole range of reasons why it hasn't emerged over the last 20, 30 years in Australia. And in large part, that's because the banks were very liberal. The regulators allowed them to be liberal. So they provided 85 to 100% of all needs, sort of debt needs. That's shifted and changed with the banking system. The second is the tax structure in Australia is franking credits. So franking credits, and we can talk about expected returns in portfolios and the way that you guys obviously are dealing with your clients. You want to cut me off for the past here?
No, I just want to hold that one because I want to come back on the first one for Anish, because I'm quite interested in that. So Frydenberg's come out saying, look, we should, the responsible lending, we shouldn't have to worry about it. So it looks like on the consumer side, they're trying to say, let's free things up. We don't want to. I know there was this Royal Commission, but that was like years ago, and so now we need to pump more money out. Whereas, and so it's from an outsider looking in, it feels as if the regulators are trying to open things up more. But you're saying that you don't think in the commercial that's the case.
Well, I think there's a couple of elements. So we met with some of the banks recently, and we meet with them periodically. They're probably the biggest referrer of business to us, saying their clients, they want to solve their problem, but it's not suited to them. Go and see Merricks or someone like Merricks. But what is endemically shifted is the banks have more tier one equity. We all know that. They've raised more capital, but how they can apply that and where they can use it is limited. Mortgages for individuals is not limited. That is by far their dominant space. So what the government has done is guiding how they can lend against their predominant lending practice, as opposed to where we're providing capital in sort of an institutional world against office buildings, agriculture, power plants. That's not as, in terms of responsible lending, is not monitored in most of that, except agriculture, which is a bit different.
I get that, but I guess I feel as if, and this is I feel as if I've got a misconception here, because I guess I've sort of felt like, well, if they're winding back in this area, they're probably trying to wind back in all areas for the banks and just let them go. But what you're saying is it seems to be much more focused, obviously, just on that mortgage side, and they're not looking at changing rules in.
I think there's elements of the banks themselves, complained, if you like, that the process was too challenging. They couldn't actually get money out to people to meet the standards that were post-Royal Commission that APRA had introduced. And so I guess it's always extremes. You get a very aggressive reaction to a Royal Commission. They go to extremes. And probably where we are now is somewhere in between the looseness that was there prior and where we are today. And it's a balance. Governments, again, as I said at the outset, react to today's problem and they say we need to get money out. And so there's two aspects in terms of lending that most people perceive, the average person on the street. One is, can I get a mortgage? And the other is people for business. And so the other thing that's happened is the Reserve Bank of Australia has provided a 3-year term facility to the banks of in excess of 200 billion at 0.1%. So the banks actually are flooded with cash if things fall within their framework that they can lend. So we really bifurcated that. The banks have a lot of money that they want to put out because the government's saying put it out, and they're saying, well, let's try and use it because it's the cheapest money we'll ever see, the most profitable money they'll ever see. And so they're trying to put it out and push it out. So you'll hear of lots of different opportunities, whether it be in commercial real estate, whether it be mortgages, for individuals, where there's incredibly cheap money. People borrowing sub 2%. And that makes sense. If you think about the banks, they generally have a 2% net interest margin spread, so they make 2% borrowing and on lending. If they borrow at 0.1, around 2% gets them close to that level. What's going to be interesting is when that term facility from the Reserve Bank of Australia actually ends in a couple of years' time.
Can you see that actually happening though? Can you see that being on track?
I don't understand what you're saying. Is there an end to it?
Well, that's the world, isn't it? And that is the world we all live in, that everything we look at today based on money that costs you virtually nothing is cheap. But it's all based on the premise that investors around the world in government bonds, right? And let's start there, because governments can act as long as everyone else gives them their money for nothing, then they can keep doing what they're doing. If the world turns on its head and said, we don't feel comfortable, and we've had a little bit of upheaval in the treasury markets in the last few weeks that suddenly saw a sell-off in tech stocks and long duration. So we know there's going to be wobbles and shakes, but as long as the world has confidence that the emperor still has clothes, we're all good.
And that's look, we've on this show a few times we've brought it up, but it's the I always get the terms right, but I think I'll have all the letters there, but maybe not in the right order. The LTRO? No, missing a letter. TLTRO.
Yes.
Where that you can basically the French and German banks are lending at 0.5%, and the central bank's chipping in 1%, and you're like, basically, just a minute, for every dollar that somebody actually pays for it, they subsidise $2 to the banks in order to, and that's where our hypothesis is, look, unless we see a sustained fiscal spend, really to try and get the inequality back. More equality back, is that's where we're headed, and it could just be.
And it will endure as long as there's no inflation, hyperinflation, and that's why everyone is worried about it. The late 60s, early 70s, that was Nixon induced, right, where he put a lot of pressure. He fired central bankers, replaced them with others. There's a history, and it's happened. And the US, there's so much literature and language, so it's easy. Everyone points to it because we've got so much data. But it's happened in many places around the world where it does get out of control. But that's the one thing where people say, well, governments can keep doing what they want unless some exogenous force them to do otherwise, and inflation's the obvious one because we've seen it before, but it will be something exogenous that shakes it up, and whether it's a virus or something else of that nature that could come along. But to come back to the thesis of what we're doing, and we talked about the WeWorks building in Auckland, we've funded quite a few office buildings and development office buildings since coronavirus struck, and the rationale for us is there's a lack of capital because it fits outside the current box for banks, And if there's no one else or very few others that will provide funding, you tend to get overpaid for what you do. Now, in the world of risk return, which every investment advisor always uses the framework saying, let's find good risk-adjusted returns.
Yep.
For us, we've found that actually in the lowest risk part of the capital stack, which is being the bank, right, as opposed to being the equity owner or taking some sort of funky structured participation. And that's because we're able to earn often high single-digit interest rates by facilitating the development of great assets or facilitating people buying these assets. We like to say we're there for a good time, not a long time, in the sense we're there to help people transition and then go back to the banking system. And so that's our job. And so we've really pivoted our business with a focus on hard assets. Why would I own it when I don't have a crystal ball that tells me where the world's going? Because there's lots of things which are scary out there.
Yep.
Despite markets keep marching upwards.
And pricing's right up there.
It is.
I'm assuming if equity prices halved or went down 80% overnight, now all of a sudden there's more incentive for you to get back into equity investing and less for debt investing.
Yeah, correct. But look, it's quite simple. Is if you can earn 8% return being in debt, I don't know that equity markets are going to give you that. So then it's sort of the world of alternates where, Tim, you introduced the topic is, okay, alternates is a reason, the space, this is the reason you head down that space on occasion for parts of your portfolio, is that it's things that can't be accessed just by going to the stock market or the bond market. And so you go into it. But in our case, what comes with it is probably not a complex investment thesis, senior lending against real assets that probably go up if inflation kicks in. So you're thinking, oh, it's actually got a good buffer around it. But how do I access it? How do I hold it? And through time, these asset classes work pretty well, but also through time, there's a litany of blow-ups and funds that people didn't understand, which is where there's always the fear. So transparency, understanding, and so it's the access of them which becomes more important than actually the investment thesis in many ways.
Or how exciting it is. It's just, it's got to be reliable and be easily accessed.
And there's lots of alternative assets that I've seen over time, and they're usually the ones that have blown up, and they're usually the ones that some financial advisors getting 10% to stick their client into it or something like that, or big tax breaks. Yeah, sure. It's just like, whereas, as you said, the assets themselves may or may not be good, but it's if you stick it around a structure that's not good, then you're gonna you're up against it.
And I think key part, one of the things you mentioned is a big part of our client base is introduced through independent wealth managers, right? And this isn't I'm not just because I'm sitting in your office do I plug it, but I think what's happened, and again a fallout of regulation and the way the system's moving, is that independent wealth managers tend to assess these things where they're aligned with their clients more so today than maybe when we started 15 years ago. And so they're assessing it just based on its merits. I feel that more than I did 15 years ago, which is an important part of the cycle. But look, there's always people that will do the wrong thing, and obviously we've got the fallout from Greenshill at the moment, which we can talk about because they do lend against a lot of hard assets also. Okay,
well, I'm putting a pin in a few things for that. I do want to come back to those ones as well. So, so we spoke a little bit about the banks sort of pulling out, and you're saying that this sector. Before I cut you off about the franking credit, so you're thinking this sector is going to grow from that perspective, just because there's a little bit of an absence of capital, which, and also because. Banks are just highly incentivized to do more and more mortgage lending, and so they're going to do this. They're
being controlled. I mean, banks will do things where they think it makes sense based on capital usage. So a bank, the Treasury Department of a bank, their job is to optimise how much capital they have to set aside against each loan, how much they have to borrow, and the things that we're doing, there's quite punitive charges for them, so they don't do it. But what's happening in Australia is we're actually going back to where we were maybe in the 80s and early 90s, where finance companies, non-banks, etc., played a much bigger part. And that is akin to what exists in the US, in Europe, most of the world. So in the US, some quote that half of lending is done by non-banks.
Right. Like a building society, so to speak.
In some ways they are. It's a modern form of that. I guess the difference is funds such as ourselves and some of our competitors is we're not levered. We're not borrowing money from people and on lending it. We are just, as you do, we just have one role, and that's to represent the investor, to put their money and ours outside, alongside them, to put it out and get the best return. So we're not leveraging it. We're aligned with them. Whereas I think building societies, finance companies, it's sort of how cheaply can I borrow money from you, and then how much can I push it out the door for, and what's my spread? It's very different. And so the issuance of bonds and things like that from those non-regulated entities often is where problems occur, because there's a lack of alignment as well. Whereas with us, if it's good for my dollar and you're aligned with me, it tends to drive a better incentive and alignment.
Okay, now franking credits.
Yes.
So.
So look, one of the things that struck me, I moved to the US in the late 90s, 2000. I got there and I was sort of this bifurcation. Australia operated in a certain way. I worked for Merrill Lynch, very focused on the equity markets at the time here, and then I worked for them there and advising pension endowments, the big ones, in that part of the world, and sort of this bifurcation. Why are they doing so much municipal bonds? Why are they doing so much debt? Why are they doing so much credit? And in Australia, it's non-existent. Everyone just wants to own the stock market and negative gear housing, right? That was, if you simplistically, how much, and it's been a great trade, right?
That's right.
What a great place to have your money, and probably still is in large part. But the big driver of it in the US, municipal bonds as an example, which are local council like, they're tax-free, the interest. So therefore, highly tax advantaged. Dividends, on the other hand, in the US, and they did change the law while I was there, were very punitive from a tax perspective. In Australia, we have the opposite. Franking credits is an incredible gift relative to the rest of the world. We're at the extreme. And so when you think about equity risk premium or equity return, generally the best forecast of any stock market around the world is the 10-year bond rate plus 4 or 5%, right? Equity risk premium.
Yep.
In Australia, we're able to cheat that a little bit because if you gross up your dividends, you tend to get a bit more. So,
and I'd even say, my story of this, one of my first jobs back in the early 90s, I was banking analyst and looking at for a broker, I was looking at Suncorp notes, and there was two different ones. One had franking, one didn't have franking, and I was trying to explain to the retail one of the retail guys on the desk that but look, if you gross up, this one pays you 8%, but if you gross up the franking credits on this, you only get 7%. So you should just take the other ones, because even with the tax benefit. And he was like, but these ones are franked. Yeah. And I was like, but even if you gross it up, and we both walked away thinking each other was idiot, because he's just going, my clients want franked dividends. They don't care. They're getting a lower net return. They just want the check back from the government.
And we've been indoctrinated in this country that that's the pathway, and so much product, and I use the word product rather than investment, by banks has been created to take advantage of that. But contrast that to debt, right? Just investing in debt. Debt, there's no capital gain, it's all interest. Interest is taxed at the highest possible rate of any entity. So sure, if you're in a super fund, it's lower, but it's still going to be the maximum tax rate. Individually, your highest tax rate. Capital gains on the other end of the perspective is obviously more attractive. So you've got capital gains and franking. For debt, you've got a very punitive tax structure. So it's not just about risk return of the underlying, it's actually the after-tax return in Australia that's so much more extreme. And so what that means for us today is that this capital formation in debt really is not done by super funds, by investors in large part. You haven't had an industry that's been created to go find the loan, to write the loan, manage the loan, manage investor money in large part, because that bifurcation's been quite extreme.
And so do you think there's a change?
There is. And the change is that the cost of that debt is gone up, right? So the returns we're able to garner right now, because of this shift and the lack of capital applied to that area, means the returns are high. And you'd say they're artificially high in Australia relative to the rest of the world, because there's a lack of capital. If you contrast that now to, we have such a deep stock market culture where ETFs and things like that, you'd argue now, well, hang on, people are getting a bit excited. They're going to hold things on a 3% yield or a 2% yield at massive earnings multiples. The like, you go, maybe we've got too much liquidity that's pushed there, and not enough that's gone to other parts. And those other parts, tax and the ability to write loans and access them is the barrier to entry
Yep.
at this point. So we need a shift and a change, and that's what's going on.
We're not giving up franking credits, though. We found that
No.
out last elections.
Yeah.
No, and that's why also, but a lot of our investors are offshore institutional clients, right, who are happily lending. You look at the big credit funds around the world, and those participating here in Australia also, it's not necessarily domestic money that's driving. So
they're effectively arbitraging by saying,
exactly.
Australian investors don't want to, are worried about their after tax, and so therefore, I can earn a higher return because they'll an Australian investor wants.
They're stealing our fat margins.
Yeah,
because we don't want them.
Well, that's right. That's pretty much right. And also then introduce COVID, that these margins have stayed wider for longer because foreigners, to get to Australia, to do due diligence, write loans, it's a barrier.
Right. Yeah.
So,
okay. And the follow on to that as well is, we keep seeing more and more about covenant light and how much, and what I mean by that for listeners is that when you write a loan, there's certain rules around the loan and what you can do and what you can't do, and they've just been getting lighter and lighter. So there's less constraints on the companies over time, which means it's more likely the companies can do. You've lent the money for one purpose and it ends up doing something else or whatever it is.
Yeah.
And so that's obviously a concern if you're just going across the entire market, especially probably the high yield end of it. I guess your thoughts on...
Well, that's a phenomena of US European markets, which credit spreads have come in. So liquid markets, things that are traded bonds. We've seen what they say cov-light type bonds, because basically if you want a slightly higher return, don't ask the company who's borrowing it to have as many requirements or as many restrictions. It's that simple. That doesn't really exist in Australia in a major way, because we're not there yet. We don't have the evolution of the market and the banking system. So most of the loans we write and some of our competitors write, they tend to look exactly, they're almost the same documentation that the commercial banks use.
Right. Okay.
So the only, the difference may be, we don't require the same income coverage, but we require the same valuation coverage, right? That's a choice because we're using unlevered money. So we don't, unlike a bank who's highly levered, they need to service their own debt. We're not so worried about, are you producing X income tomorrow? All we really care about is, if we lend you 60 million, is the asset worth 100 million in 2 years' time? Are we really comfortable with that? Yep. That's our focus. And so it's more akin to the equity investor or the stock market investor. It's the general
would you
wealth
say,
industry.
And I guess what I'm trying to get to for this is, you think that's that's not just you guys saying you're going to be quite strict on the covenants. That is a generally an Australian thing. You think that
I don't think it's necessary. I don't think the borrowers are pushing for that to the same degree.
Okay.
I think where you will see it first, it's in the corporate cash flow lending. So business lending, that's where, and so that cov-light term is often used, and where it really emanates is from private equity borrowers. So they buy a company, they go and borrow money from credit funds, and they tend to be cov-light and structured and super highly leveraged. And so that's where the high yield market, the junk bond market, really has emanated. But we've got to a point where you look at the US in particular, and people are lending money at 4%, 5% to super highly leveraged junk, right?
Could lose 95% of your money. Yeah,
you could. I don't know the debt you'll lose 95%, but you could lose 20. But if you're making 4 and losing 20, it's the wrong risk reward. Our view is if we're making 8 and something goes wrong and you lose 1 or 2%, that's the right risk reward in a portfolio, not the other way. So I think we're early on, and to put in the context, the 4 major banks in Macquarie, and maybe you throw in Rabo because they do so much agri, it's a $4 trillion balance sheet amongst the commercial banks, and we think that the non-bank sector is probably in the 100 billion to 200 billion space. And probably gets to 500 million. 500 billion. They're such big numbers that we're always talking about, but 500, 600 billion. And because the non-bank space is unlevered, right? Banks can easily swell their balance sheet because to lend 100 billion, they only need 10 billion of equity.
That's right. Yeah.
Yes.
For us to lend 100 billion as an industry, we need 100 billion. So it's a massive shift in transfer. So it's not easily solved. And then the other aspect of it is you can't just ring up your friendly broker and say, buy me 1 million shares of CBA and you suddenly grow your portfolio. You actually have to find the loan, underwrite the loan, go through the whole process. And so you're replicating the banking system.
Yes.
And that's one of the shifts in the change. So for a whole range of reasons, we've liquidated all our equity portfolios. We've moved to this space because we think if you can earn 8 to 10% return, we think you're getting the equity market return plus franking and without the same risk. And so we think, competition will increase over time, but because it's hard, it takes more than 3 guys in a Bloomberg terminal to compete.
Yep.
We hope, right, and this is, I know, acknowledge the bias, we hope it endures much longer, and we can keep...
And it gives me a little bit more... because I look at that, the US, for example, and to see record levels of corporate debt versus GDP and all this stuff about cover light, you're just like, well, I don't know when there's going to be a problem, but there's going to be a problem sometime in the next, 5 years, call it.
Absolutely.
But it sounds as if... when I look back at the Australian one, and I guess coming back to the property side, we saw in 2007, 2008, a lot of the property guys were all levered at 60, 70%, and so they had a lot of problems when the downturn happened. This time it was more like 30 or 40%, so there's not as much of a risk in there, and it sounds as if the covenants... So it sounds as if we're looking for dangers in the Australian economy, it's probably not on the corporate debt side, it's probably more likely to be somewhere else.
Yeah. I'd say the biggest danger is people not doing what's advertised on the box.
Yeah.
That is as soon as you get into something that's less opaque, and sometimes that is associated with alternates, that's where the issue. And so, we obviously have a big supply chain lender in the world right now with a problem.
Yes.
And clearly the biggest issue is...
So actually, do you want to give a little bit of background for anyone who hasn't been following the Greensill?
Sure. Greensill, which is an Australian-based company, but it's become global, provides supply chain funding. So what that really means is they'll provide debt against people's receivables. There's lots of complexity to it and different things they do, but that means if you're owed, you sell a product to BHP and BHP owes you $1 million and they'll pay you in 3 months' time. As a supply chain lender, I lend you money against, I might lend you 900,000 of the million to, BHP's good for it.
Yep.
But the reality is this gets bigger and bigger. Many of the receivables are not from BHP, they're from lots of different smaller companies. And what's happened with Greensill is many things, but what's obvious from the outside is that the insurance industry's changed and all of these receivables were supposedly insured. And it appears that many of them were no longer insured. And there seems to be a disparity between what Greensill suggested that that they were insured and what the investors in them, being Credit Suisse and others, thought they were. So what is on the box saying if it was insured and wrapped, not a problem. But if it changes and you're suddenly doing something which is a misrepresentation, and that's the history of banking finance, and you can you can wander into these things where maybe insurer turned up one day and said, we can't insure for the next month. They go, we'll leg it. We'll hope that you come back, which they shouldn't have done. and then the whole industry falls, and the insurance industry changed. So
and the other factor as well in Greensill is one client, which seemed, it was 50% of their book or something like that, I think.
Yeah, which is crazy.
Yeah.
It's like, on many fronts, the groups providing them with funds, the investment banks and others who put all their clients into it, you've got to ask the question going, what were you doing, right? Due diligence. And then just the management of it themselves, how, that extreme. So it's, that's no different to any equity manager saying, I'm going to...
put 50% of my money into Tesla.
Correct.
There we go,
Yeah. And sure enough, they've had a great year last year and massive... performance and all that sort of thing, but it hasn't been such a great month the last month, has it? If you own Tesla.
Do you think it's a one-off? Do you think there's more Greensills out there, or do you think this is?
No, I think it's human nature, right? Yep. That's history says it's not a one-off, but you're asking, is it endemic in this sector right now?
Yep.
I don't know.
Well, I guess the issue I'm interested in is this something? This seems to be. Okay, how can I put this one? Okay, come back to the financial crisis, and you had these mortgage all these mortgages being lent on a certain business model, and then all of a sudden the business model went, okay, this isn't working anymore, and one by one the mortgage funds all started falling over, and the capital dried up, and next thing you know you're in a financial crisis. I guess what I'm trying to work out is it doesn't seem that Greensill's in the similar boat where, all of a sudden all trade finance stops. Because I guess what I'm saying is, to me, if all trade finance stopped tomorrow, yes, we're in a financial crisis, and it's obviously hard for central banks to get back in. Could this be the domino, or is this just one player that's...
unlikely.
Yeah,
most trade finance comes from banks.
Yeah.
It's unlikely to be an issue. These guys were probably pushing the boundaries and earning a slightly higher return for it, which was fine, but it had an insurance wrapper around it.
Yep.
There's a lot of export finance, trade finance, all those sort of things, which is not our market, but relies on insurers to provide a credit wrap, right? And that's how people tend to get comfortable.
Yep.
Part of that is people that invest in that space are kind of outsourcing their risk management to an insurer, which in itself is problematic. And so
especially as you said, that you can turn around and go, yeah, I'll give these guys a bunch of money because it's insured, and then insurance guy 6 months later goes, you know what, I'm not going to insure that anymore, and you're sort of going, you're left high dry out.
Well, it's always the issue. The world changed. It was a good idea at the beginning, and it was a good idea for the last decade, and it got too big, and the nature of the world changed. And that's your job, right? That's your job to understand, like, for your clients, which space, where's crowded, where are people pushing too hard, and that's the general nature of it. But I don't think Greensill's the forebearer of lots of supply chain finance issues.
It's not an endemic problem in the supply chain finance. It's more likely just to be
the endemic problem in the space is the insurers don't want to insure the space.
Yeah.
So it's not actually that people have bad credit books. It's actually that if a system is built where it requires insurers to provide it, and insurers who have been under pressure from many different events around the world say, we don't want to provide this type of insurance.
And the falling interest rates are affecting them obviously as well.
Correct. So they can't generate a return, and so therefore they can't put their premiums to work, which is their business model. So that's an issue. So what you can see is suddenly business, right? And you think about Australia, how many businesses in Australia rely on export finance or factoring or receivable funding from banking system and other? If the insurers aren't there, that's a problem. It's not Greensill. Greensill didn't create this problem. It was probably Greensill was probably suffered from insurance pulling back. But what that will mean is the price at which Greensill offered that factoring debt was probably low relative to where it needs to be. So as an investor, the opportunities to come in and to invest in space now, it's dislocated, and you can take security, first-ranking security over that type of lending, which, again, just to be clear, it's not what we do, so it's not, but it's the nature of go into a market, it's dislocated. Greensill were getting paid 3%, or the provider of it, who's going to come in now, is probably going to get paid 8%, and they're going to impose all of these rules that weren't being applied. And that's the nature of, that is where alternates as an industry has been, in large part, has done really well for decades. It's that ability to move to the space where there's a dislocation.
Find the value. And go there. If you go there after there's a problem or there's a vacuum of capital, you can actually have much tighter covenants and much tighter rules. And so, whereas 6 months ago, trying to be the next player in to compete with them by offering 2.9% rather than 3% is not. Correct. It's not a good market in there. Correct. I've got a quick one, and I'll just jump back. So obviously doing a bit of research on your firm, Adrian, you've got a bit of coverage in the agricultural space, and obviously I think, and in my experience, when you're talking to high net worth clients, you'll typically find more agricultural for, I think, for the alternate reasons. It'd be great to sort of get your view on perhaps, or some background on what you've been doing in that space, and I guess your view for the future. We've had a bit of a wet summer. Sometimes that might indicate a good few years in agriculture. Yeah, so a couple of good points there. The tailwinds in Australia for agriculture are very good. The tailwinds for agriculture globally are quite poor. So the rest of the world has actually, and I'm using a broad brush approach when I say the rest of the world, but South America, North America, Russia, Ukraine, Chinese plains to some degree, the big food bowls of the world have actually had a tough year or so.
So there's been less production of food and fibre, and so that's driven commodity prices higher, whereas Australia, that came off a drought, had a fantastic year, and so actually has had good production and receiving great prices, and dams are full, which means we've probably got good water allocation for a year or two. So the forward look is relatively good at this point in time.
Do you think is some of that supply chain disruption in terms of shutdowns and lockdowns, couldn't have as many people working or things like that in overseas, or
well, it's certainly true in Australia. So just a little bit of history from our perspective. We have been very active in the space since the day Merricks was formed. It's a passion of a number of the founders, the food supply chain. During 2007-8, when we first started, we were on the back of a drought in Australia, and we bought a whole series of farms because people were selling what we deemed to be cheaply because of a drought. We held them and we sold them 6, 7, 8 years later, and we did well out of them. But it was a miserable ride, to be honest. Like managing agricultural assets is really challenging. And so one of there's a number of reasons for it. You're dealing with weather, so it's very unpredictable. You're dealing with global commodity prices and FX, which sort of deal with it. And then the hardest piece is, like anyone that's had any business, managing people is the hardest piece of any business, the human interaction. But put people into more difficult, challenging environments, remote locations, the challenges that regional Australia faces, and it adds all sorts of complexity to it. And so for us, we sort of, again, it's been a little bit of a gift as an investor, where we have a team of people who manage farms for lots of different groups. We pulled back out selling assets ourselves, so our funds don't actually own farms anymore. But we thought, wow, we get to actually lend to a space we understand, but we don't actually have to manage them, which was a joy. But where we believe, and there is a wave of money, and people raising funds to buy farms, and they have a view on agriculture. When you look at the returns, they're predicting, maybe 3%, 4% income, and it varies between 3 and sort of 5% capital growth. So pretty traditional, but it's highly variable what they're going to achieve. So we're happy to have those partners, and we're happy for big pension funds and others around the world to come in and be pumping money into what Australia desperately needs, is investment in that agri supply chain. But we're happy to be the lender because we've got a few war stories to tell around it. So our view is we're very active, and we don't see a lot of competition from outside the banking sector. Whereas in commercial real estate, there's a lot more competition to lend. In agriculture, we don't see as much.
And I was going to say that it seems like NAB got beat up a fair bit for in the Royal Commission for pulling farms off farmers or whatever, and so I'm not sure if that means they're sort of pulling back in their space as well.
No doubt. New Zealand in particular, New Zealand and Australia. So between the two countries, the commercial banks have around $130 billion of agricultural debt. Our estimation is they probably need to give up 30-40 billion of that because it's not suited. They're not suited to weathering a drought. It's if you need interest every year, and your customer, the borrower, has a drought every 4th year, so they're a bit boom bust. You need to have something which is a bit more durable, which is you're not lending to them with your own highly leveraged balance sheet. So it's challenging. I think it's challenging for the banking system to provide every loan to the space. The Royal Commission is definitely an issue, post-Royal Commission for the banks. And look, I'm the first to stick it to the banks, where it suits me, right? But I got to say, I think what the banks have done for a lot of the farming industry has actually been incredible. Like, if it was you or I, if I lent you $500,000 and you bought a farm for $1 million, and you turned up and I said to you, got to pay my interest and you got to repay me, and I then turn around and say you're evil, I mean, I think most would be like, I just did it in good faith. I didn't do anything wrong. And I think the banks have actually been willing to facilitate all sorts of things for the agri-industry.
But the media loves the story where I go, my great-great-great-grandfather bought this land and we've been on it for whatever, and the bank's going to kick me off. And as you said, it plays really... The media loves to play that story.
Sure. Yeah. And if I was the borrower, I would say that too, right? Because you're desperately trying to hang on in a very unfortunate situation. But it brings us to the issue around COVID in general and what the banking sector and governments, in terms of the relief that's been provided. I I think it's been pretty generous, right, in terms of general commercial terms. And so it should be. When the federal government's lending you $200 billion at 0.1, you need to then provide a lot of accommodation somewhere else. So there's a bit of an offset to all of that. But in talking to the banks, there's very few loans that still sit in that space where they're not being serviced and they're not performing. I mean, there's sectors, tourism, disaster, right? Like it's a real problem.
Yep.
But most, and people can name a few others, but the banks actually, the performance of their loan book is been really good.
I'm going to do this as a very slight diversion. So the federal government said they're going to lend $40 billion to the small businesses, and ended up lending $2 billion, I think. In terms of that, do you think that was the banks just didn't want to lend to that sector? Is that the? Yeah,
look, I think the banks will still only lend if they think it's a good loan, right? So the banks want to lend if it's a no-brainer, right? That's the space they operate in. So to get there in small business, it's hard, but it's also hard in the sense the certainty around cash flow lending is more challenging than if you turn up and you say, look, I've bought this $1 million home, will you lend me $700,000? And look, I've got a job. It's pretty easy. Right? They're well suited to actually make an assessment, have your crystal ball out and say, wow, you're a metal extruder based in Western Sydney. What's the outlook for your business? And I'm going to lend quickly. Not that easy.
No.
And have they lost the skills, do you think? Like, so was it just that the government called upon the banks to sort of provide a bit of a screening element to, and obviously the government was putting in half the protection, and then the banks just sort of potentially fell apart because they'd lost the ability to quickly size up a business or lost the skills perhaps as well?
I think every bank is working at home. It's pretty hard to do small business lending when you work from home.
Okay.
Like I think the working from home phenomena for big businesses such as banks, accounting practices, our experience is the service that we get and provide for them it struggles on large part. It's easy to deal with, as you guys would know, your existing client base who you have a deep relationship with. You can continue to provide great service. To facilitate new customers, new small business lending, it's really difficult.
In a time of duress as well.
Well, you need to be out there, you need to be on their premise, you need to touch and feel it. That's traditional SME lending, and so it's difficult.
Yep. Okay.
Developers. So I guess what we had been hearing was that the banks just completely pulled back from that space, and a bit of a struggle for developers. How are things looking now? What's the state of play in that market?
So you need to again bifurcate the space they're developing in. When most people think of developers, they think of apartments, right? Yep. That's the average person listening would that's where they would go to. If we go back to 2015-16, that was for us the most fertile opportunity. The banking system pulled back. There was APRA and the Reserve Bank and the government were rightly looking at apartment pricing, foreign investors, a very heated market. And so we've spent the last 3 or 4 years with a retrace in terms of banks lending to developers. So COVID certainly didn't play any impact because it was sort of done and dusted, this retrace.
Yep.
And so what we saw through that process is we saw governments introduce all sorts of barriers to foreign buyers buying off the plan apartments, so that market dried up and disappeared. We saw investor borrowing become quite challenging even for Australians, so they were reluctant to buy off the plan, and so we've ended up with a housing market, an apartment market that's predominantly owner-occupied. Predominantly, I mean, everyone will be able to point to friends that are still accumulating some investment properties, but in large part, it's an owner-occupied market, and that market is bifurcated into two. In December, January, so the most recent data we had near record new applications for single-family homes. That market is booming. House and land development is absolutely booming. Yep. And so that is, again, a big area for non-bank lenders and banks. We're seeing lots of sales of house lots near record levels, homeowner grant, first homeowner grants, home builder grants, regional home buyer grants, and then a backlash from COVID saying, I don't want to live in an urban 50-storey building. I actually want a house and a bit of a backyard.
Yep.
And so that backlash has sort of pushed a lot of people to that space. And regionally, we're seeing outside of Sydney, Melbourne, Brisbane, we're seeing the regional push. So that market is, and so there is a fair mix of borrowers that just can't get access to banks that still need it from non-banking, but it's also a good place for banks because sales to consumers, so house lots and new homes, are pre-sold. If there's really good pre-sales, it fits within the banking system.
And I'm guessing as well, it's also, if you've got 50 borrowers who have all borrowed $1 million each from you, your risk is a lot lower than if you've got one borrower who's borrowed $50 million for an apartment.
But even the land developers themselves, who are akin to the apartment developer, the pre-sales are good, the covenants are there. But they're also smaller projects. You tend to develop in 50, 60, 100 house lot sales, so it's smaller. The dollars are smaller,
and they can delay the releases a bit more.
Correct. So it's planned. But what it does do is it means that we actually can't produce a lot of homes in Australia because it's still the likes of Metricon going and building house by house by house. Apartments is the formation of the household can happen a lot more quickly in an urban context. And so if we look at the numbers for apartments, in the most recent months, we have seen applications for new apartment development around 3,500 apartments. At the peak, going back to 16, 17, we were run rating 12, 13,000 apartments. So we've fallen 70, 80%. And so if you annualise that, we've gone from producing 140,000 apartments at the peak, maybe in a single month that peaked it was sort of 160,000 run rate, to now being at a point where we're probably run rate 35, 40,000. So we're producing 100,000 less homes. If you produce 100,000 less homes, there's far less need for capital. So the banks... So it's sort of a moot point. It's like, are the banks back? Well, back for what, right? So
they don't need to be back.
They don't, and so we actually think now, the skill in our space is actually producing where there's going to be a lack of supply in a year's time, 2 years' time, 3 years' time, where you want to go and lend. And so for us, that's been in office a year ago when COVID hit. We saw a lot of stalled office development. We still foresaw in pockets where there was need, and we went into that space. In the last 3-4 months, we've been much more active in hotels as well. We think the hotels will come back. But if we go back 3-4 years ago, we were quite active in Perth, where everyone said Perth's dead, mining cycle's over, stop building all new apartments. And we did the forecast and said there's going to be a lack of supply here. And I'm obviously telling you a positive story. Most people don't come in and sort of tell you, necessarily all their bad ones. But it was obvious to us that all of this potential supply in Perth wasn't going to happen. No one wanted to lend, and Perth is now the tightest housing market in the country. It's that simple. If you don't produce. So Australian population growth, we've been run rating over the last decade 1.4, 1.5%. In terms of population growth, so somewhere between 300,000 and 400,000 people. This year, last year's numbers were 1.2, so we were down a bit. Lots of question marks about what migration is going to look like, but you're still probably going to grow at 1%. So we're still going to add 250,000 Australians. You add 250,000 Australians, you need another 100,000 houses, plus the repair and recycle of existing. So if we undersupply for a while, we'll have the issue. So the good news for everyone that owns a home is that the lack of supply in many areas is still there, and we're not seeing... We just can't build enough single-dwelling homes at the pace because of the nature of our labour market. We have a highly structured labour market, an expensive labour market, so to build lots of houses and apartments quickly doesn't... Apartments you can build quickly, houses you can't. So that's the supply side.
And it's a little bit... when you say that, it's I guess what you're saying is if you needed to build 1,000 apartments, you can build them quickly versus 1,000 houses. But in terms of actual time frame, to build a house, you can be done in 6 to 12 months. Whereas an apartment, 3 years or whatever.
But you don't have manufactured production. You can't.
You're talking about the sort of like the productivity, so to speak.
Correct.
Is far higher.
Correct. And in terms of one of the good things about Australia is that occupational health and safety, and not many people get injured and all those sort of things. But it means we're a lot slower than the rest of the world.
Yes.
So we think apartment supply, which we're now hearing. I was actually, before coming in here, just talking to some developers in Sydney. They've actually started to see a pickup in pre-sales of apartments in Sydney, whereas Melbourne's dead.
Yep.
And I think the two cities, if you take the two biggest cities in the country, there's a massive bifurcation. Spend some time in Sydney, you'll see relative confidence, people getting on with things. You come to Melbourne, it's people are battered and bruised, and I think getting people to have the confidence to go and spend and buy a off-the-plan apartment and have some view of where it's going, it's quite different.
Yeah.
Yep.
And we're seeing that in the numbers. We're seeing that in the demand for borrowing and who wants to go in terms of developing.
Well, it's fair to say I think our COVID hangover is a fair bit longer in Melbourne than it is in Sydney as well, perhaps. So.
Yeah, no doubt. And look, the interesting thing is the savings rates in Australia and all around the world are unprecedented. Like, there's so much money sitting on the sidelines because people didn't spend it. And I talked about, we like tourism or hotels, that is a place we're playing. And that's as simple as Australians as a whole, we spend 35 billion more going overseas than foreigners spend coming to Australia.
Yep.
So I'm not saying our total spend, just the difference is 35 billion.
Absolutely.
If we travel domestically, and we, not even to the extent that people are spending going overseas, but they just get part of the way there, we'll make up for every foreigner coming to Australia and some. And so for us, we think things like tourism is easy to identify. It's an air pocket rather than structurally dead.
Yeah.
We can debate.
We're the same in terms of we've polled in sort of once vaccines were out, and we've copped a lot of flack for it but just yesterday they came out with the announcement about all the flights that are going to be funded and all this extra government support for that sector.
That's the magic wand at work, isn't it?
Yeah, so for us, we've been financing some hotels, completed hotels and the like. Again, it's not as challenging decision for us as is the owner. We're lending 60% of the end value. But the other thing, you look at all physical buildings in Australia. We've recently had the enterprise bargaining agreement between the unions and the building companies, and we look like we've got 4 or 5% wage inflation locked in for construction workers for the next 5 years. The cost of building is not coming down, so replacement cost of buildings is not coming down. So the only thing that when we look at these things that can give is the land value, because the built form is not going to get cheaper. The changes in supply chain, less reliance on China, because we've had some hiccups over COVID that things don't turn up, so there needs to be some alternatives. Expensive labour force. So a building's not getting cheaper. Land obviously can go down to reflect supply-demand issues, but generally you'd say the built form of a building's not going to fall, and the endemic use is still there.
And it's probably coming back to what you were saying before as well, isn't it, that about the productivity side, I guess. If you're running it centrally and you said we need to produce all these houses, we need to go out and produce another 500,000 houses, you could do prefabs and all these other ways of getting stuff done, but that's not what happens. When people buy a house, they're like, no, I want this. Even if you're with a Metricon, you're like, yes, I want this house, but I want this change and that change and that change, which means, again, just slows it down, doesn't it?
Yeah, no, absolutely. I mean, Metricon build 4,000 homes a year, not 100,000. They just can't do that. Whereas a really big apartment developer, we're looking at some proposed apartments where in one precinct they're going to build 2,000 apartments. It's possible to get it done.
Very good. We'll look mindful of your time, Adrian. I have it was a lovely segue talking about construction wages. Just quickly, your thoughts on inflation. We've got a couple of charts up from our predictions, and I think we use the term air pocket there, and there's sort of a bit of a COVID air pocket in inflation, Damien.
Yeah, can I just, because given the time, sorry, probably not an expertise of yours, but I just want to get a quick question in on commodities before we go, given that's so. We've seen prices spike, significantly higher in most commodities, and there's a little bit of a circular reference in that they're sort of saying, hey, look at this inflation coming, therefore financial investors are jumping into commodities and commodity prices are going up, and they're going, then they're saying, hey, look at inflation from energy prices going up, or look at inflation from copper prices going up, and going, yeah, but you caused that. Like there's,
sure.
And so there's, are you looking upon? Are we in a super cycle, or are we?
Look, there's a saying in commodity markets, and we have a commodity fund as well where we trade agricultural commodities. Basically, high prices in commodities will be solved by high prices.
Yes.
And the same is true of low prices. Supply demand, particularly in food. So let's start with the area that can react the most quickly.
Yep.
If the prices are really good for corn, wheat, people will plant corn and wheat, pillar to post. It'll be everywhere. They'll spend a lot. Now you need weather to come to the party as well. So it's not, but they tend to respond.
Yep.
Oil is probably, and copper at the other extreme, they're probably 10, 15-year cycles. So you have to look at what's gone on. The oil price moving in recent times is a combination of really a couple of factors. Basically, the oil industry overproducing shale oil and really damaging investment to bring it on. So it sort of led to lesser supply. OPEC came to the table and said we have to cut supply because we just can't balance the budget in Russia, Saudi, etc. Without doing that, you then get hit by some exogenous factors such as the weather in Texas and others, and suddenly you get that shock. Those same factors are always true in every inflation push throughout history, right? It's when the global supply chain in one form or another breaks down at the same time where you've had the underinvestment. And so commodities has not been the place to be the last several years, 2, 3, 4 years. But you look at
last 1 year, it has.
I think if you go back in terms of the performance,
over a longer period of time
in general, really since 2011-12, where China turned the tap off, they overstimulated, and we've had a more benign cycle, and so we've had lack of investment. The joy in Australia with iron ore has come that exogenous fact where Brazilian production has been hampered by disruption, collapsing. So it's always, if you look at the inflation shocks of the 70s, it's that combination. You need the combination of money printing, mismanagement by governments and central banks with an exogenous shock, the Middle Eastern crisis and things like that. And so to get ongoing inflation, we need some exogenous shock. Otherwise, supply-demand will balance. And so we need the supply chain to be disrupted. The one thing I would say about commodities, to me, everyone focuses on what the Fed's doing and the US because we get so much data. One thing that's very clear, and even this week, the news out of China, the new 5-year plan, China is very hawkish. Like, they are not going to overstimulate the way that they did post-financial crisis. Western world seems to be no end to it. China, which obviously is more important in the commodity cycle, seems to be much more focused in not producing oversupply of housing, factories, so very commodity-intensive product. They'll maintain their growth, but they seem to be much more hawkish, and they're actually pulling the reins in a bit. And it's not surprising when that happens. If you look through history, equity markets start to sell off. So the Chinese stock market selling off at the time when the system in China is starting to contract that monetary supply, that's not inflationary to me. So I think betting on inflation right now, short term, doesn't look like a good bet. What is much more of an...
So when you say short term, you're saying betting on sustained inflation?
No, I think betting on inflation to be a market phenomenon the next 12 months or year is not the driver. I think it's because there's still a lot of slack in the labour market, in factory output. But as we turn out of, we come well and truly out of the sort of pandemic, I think it's really clear that from the RBA to the Fed to every central bank, they will overstimulate for too long, unquestionably. And so there's going to be a pain trade at the end.
And it could be 5 years away from that.
But I think it's less one-way traffic. The sell-off in the tech stocks, the growth stocks here in Australia, it's a shot across the bow, right? Saying, hey, they are incredibly richly priced, so therefore it's not going to take much to bring them down in one-way traffic. So the world's harder. When values are so rich, you're not going to get massive performance because we're no longer going to get that multiple expansion in equities. We're not going to get cap rate compression in property. So you've just got to rely on good old earnings.
Yeah, I know. Yeah, which a lot of those don't earnings. What's that?
Correct.
You have to look up the definition of that one.
Very good.
So on the commodities side, though, so are you so agricultural stuff you're looking at? Are you doing anything in metals or energy?
We are active in power.
Yep.
It's the only place in our entire business at this point in time where we're applying equity. So we're actually building 2 power plants in Darwin.
Right.
One solar farm and one gas-fired power plant.
Mm-hmm.
And so we like the power sector because the politics is so screwed up.
Yep.
So again, if you come back to our basic premise of do we have expertise and do we understand it? Well, we believe so. We've been ticking away at it for a long time. And is there a lack of capital being applied? And so we would say in segments of the power industry, there's massive underinvestment going on because it's so confusing.
And so much policy uncertainty.
Correct.
Yeah.
And the reason we're in Darwin and not in Sydney or Melbourne or Brisbane is because that market doesn't sit on the national electricity market. So it doesn't have quite the same politics. It's a smaller market. It's friendlier in some ways. And we're also gone to a market where the incumbent power producer is a state-owned power producer. So there's no other competition, and they're quite open to working collaboratively, and so it makes sense. But a lack of investment nonetheless in the space because people are sort of sitting there and saying it's too hard. So we always like to go where we like to be in the I guess, relatively simple investments in places where people say it's too hard to be.
Yeah.
That's sort of our
Excellent
ethos at the moment.
Great one to finish on, and a nice lead into our special guest next week, Ross Garneau, who is a big power fan as well. We might have to get you back, Adrian, at some point to chat around the power investment space. We do quite a lot of work on energy,
Yeah, no, we're happy to do that, and Ross, obviously, his background in China as well, very intriguing. So obviously, what's going on in that part of the world, but yeah, look, power sector, there's. For us, power and water, so water's an adjacency to agriculture. They're 2 elements where the politics is scaring investment more than anything else.
Yep.
And so it makes it really intriguing.
Yeah, wonderful. A quick investment outlook, Damien, if you quickly.
Yeah, so just want to highlight, I think coming back to what you're saying is we've got a similar view, I think, in terms of inflation, in that over the longer term, we're not expecting inflation. I do think in the next 6 months we're going to print some really high headline numbers, which is just base effect. Low, and oil prices doubled and all these other factors. So I think there's going to be some big headline numbers, and my view is that this is going to be the 10 minutes of sunshine for the people who've been talking about hyperinflation for years and years and years, and that they're going to get the front and center. And so I guess what we're actually looking for bargains as that comes up, if you know what I mean. So if it doesn't happen, well, it doesn't happen. But we're actually expecting that there'll be a bit more noise around inflation. It's one thing for a central bank to say we're going to keep rates low for an extended period of time, and you've got 1% inflation. If you're printing headline inflation of 3 or 4, just for purely base effects and weird stuff going on, I think the market will start just naturally pricing in a bit more. And so, so we're looking at that as an opportunity. The flip side is what you spoke about, is saying, well, if it is unlimited taps and Biden comes out with a $5 trillion infrastructure stimulus and all this other stuff, then maybe inflation is coming. But I think at the moment we're on that same part as you, going, yes, supply chains will recover. There's lots of slack out there in the employment side. With a much bigger services economy now than what it used to be, and also that the stuff that got shut down was mainly services, and the stuff that managed to keep going was a lot of that was manufacturing. And so once services starts coming back, there's that extra lid on inflation as well. And so so we're looking for opportunities over the next 6 months to take the opposite side of that trade. So I certainly wouldn't be saying I'm out buying growth stocks today, but I'm certainly going to be looking for growth stocks that are getting hit too hard, and but with a real view to pricing, because there are definitely segments of the market that are just priced. Fantastic companies, I love the outlook, love everything about them, but the price is just so high that I just can't see how they could possibly do it. But at much lower prices, there's plenty of companies on our shopping list.
Excellent. Thanks, Damien. Thank you to you, Adrian, for coming
Pleasure.
in and sharing. We've gone a little bit over time as
No
well,
problem.
so you've been very gracious. Just a little bit of information for our listeners on yourself, on how they might follow some of your work, and perhaps what an ideal client could be for yourselves.
Yeah, we're Merricks Capital. We service the institutional fund manager, but also individuals pretty much through their wealth manager. So we have one fund, the Partners Fund, which is basically all our best ideas. You can find some information on that at our website, www.merrickscapital.com.
Yep.
Where we tend to talk about our best ideas, and you can find out some information on our fund. But as I said, really for us at this point in time, as the world gets more complex, we're trying to keep it simple. Senior secured lending against hard assets. That if the inflation genie does get out of the bottle, I'm wrong, they should be protected. But look, we just think if you can generate an 8% return, and we've been doing a bit better than that, but if we can generate that type of return with not too much risk, it's a great place to hide.
Yeah, absolutely.
We'll get some links in the show notes for anyone to those as well.
Absolutely.
Great.
Yeah, it's great to have you on, and look forward to getting you back on soon.
Thanks, Tim.
Wonderful. We'll jump across to our viewer question of the week. So feel free to drop into the YouTube chat. Where do you turn for alternative investments? I've got a sneaking suspicion one that'll come up that we haven't covered today might be cryptocurrency, but it'll be interesting to see what our...
I'm assuming cryptocurrency doesn't meet your definition of hard asset.
No, it's probably the extreme opposite.
The
I would
opposite.
say.
Yeah, exactly. Well, there you go. But so happy to hear your thoughts from our listenership. As I mentioned before, coming up next week, we continue our run of special guests with renowned economist Ross Garneau. Ross is coming in to share with us some of the highlights from his recently released book Reset, which focuses on the opportunities that lie ahead for the post-pandemic rebuild of the Australian economy, and how now is the time to embrace new thinking to ensure prosperity into this century. So tune in next week, Thursday the 18th of March at 12:30 p.m. for what promises to be an enthralling chat with Ross. And of course, we will be saving plenty of time for your questions in the live stream. Thanks again for all of those that have watched in live for another great episode, and I hope you've taken away some great ideas. And if you haven't already, feel free to click like on the video now to give us some feedback. If you'd like to see more of our content, head on over to nucleuswealth.com/content to stay up to date with news from us. Follow us on social media. And finally, if you know anyone who'd get anything out of today's episode, let them know about it, share with a friend, and help our show grow. Thanks again for tuning in from myself, Tim Fuller, and the team, and we look forward to catching you at the next one.